Hello, ladies and gentlemen. Welcome to the FSMOne Nomura Fireside chat. In the past 2 years, the concept of environmental, social, and governance has become a hot topic with investors globally. Although ESG is not new, I believe that ESG is not new for you guys, and it's starting to gain investors' interest as ESG investing catches on the Malaysia. Before we start the presentation, please allow me to give a quick introduction of our speaker today. Mr. Leslie, he's the Managing Director for Nomura Asset Management Malaysia, Sdn Bhd, and the country head for Nomura Asset Malaysia business in Malaysia. He has over 24 years of industry experience in funds management and research coverage. And also he's a CFA chartered holder. While the other speaker is Tien. He joined Nomura Asset Management Malaysia as an investment executive since November 2022. So prior to joining the company, he gained some investment research experience with the incorporation of ESG factors through summer internships at Riverwater Partners in the United States. Tien is also a CFA Level 3 candidate. Today is our pleasure to invite Mr. Leslie Yap and Mr. Tien from Nomura Asset Management to provide us with a valuable insights as how Nomura Asset Management Malaysia investment approach can strike a balance to deliver both financial returns while creating a positive impact to environmental and social. So if you have any questions to ask these experts, feel free to post your queries on the chat box and we will address this question to them. Without further ado, let's carry on to the first question. So Leslie, what is the ESG in general and what is it mean to Nomura Asset Management?
Hi, good evening, Kevin. I hope you can hear me and everyone can hear me clearly. Well, before I start to answer the question, again, thanks for having us on your platform and on this evening session. Yeah, you're right in the sense that, ESG is like, in the front and center of every investor's mind. Maybe not on the individual level, but definitely if you can see on the news at the institution level, the government, the pension funds, sovereign wealth fund, everyone is focusing on that. What does ESG mean? Is you also highlighted that a lot of the participants or the audience will know ESG. Obviously, the acronym itself, I wouldn't need to explain. Basically, E, environment, S, social, G, governance. But that's not the answer I think you are looking for. What does it mean for Nomura when it comes to ESG? We spend a lot of time, maybe just to give everyone a bit of a background, we were a signatory of the United Nations Principle of Responsible Investment back in March 2011. What is that? What is this UNPRI or PRI now it's known as? It is basically a commitment by the firm, not just the one in Malaysia, but our whole group, in terms of practicing responsible investment for our mandates. And that was back in 2011 when no one probably bothered or looked at ESG in this region. But obviously, globally in Europe, it all started back in 2011. And then as we progress, having signed the UNPRI, we said that in 2013, we started to incorporate responsible investment or ESG investment in our research process. It's been quite a journey because after 2013, we started to have the reporting of our responsible investing activities. Right? People say, oh, you do ESG, how am I supposed to know? Everyone claims that you do ESG. So having incorporated in our research in 2013, 2016, we started to produce quarterly reports. So people know what we are doing. And then following that, we launched Global Sustainer Equity Fund. Then this year, we also launched a Sharia version of the Global Sustainable Equity Fund. So it's a long journey, but the journey is just starting. We'll continue with that. But having explained a little bit of history, if I may just sum up to your question, what it means for Nomura Asset Management. We tried to make things simple because we brainstormed and things just got too complicated. So we ended up with the answer as ESG is just the simple and the right thing to do when it comes to investment. Right? Simple and the right thing to do when it comes to investment. if you want to elaborate a bit more on that, it's just that when you invest as an investor, you are just one of the stakeholder, in the capital markets. So basically, aside from being a shareholder, there are other stakeholders in the whole ecosystem, right? So whether you're a supplier to a company, the company that runs its business, the environment. So there are various stakeholders involved. So again, when it comes to ESG investment, we are trying to strike a balance whereby we can find some sort of a positive and balanced impact for all stakeholders. Our life and the world is never so simple as, everyone get to benefit. But it's just a matter of getting the balance right so that each stakeholders can benefit from some sort of positive impact.
Well, that's a very, very good explanation. Thanks, Leslie. So, Tien, how do ESG criteria impact investment decisions and portfolio construction? You have also companies with business that are not impactful at first glance. For example, a pharmaceutical or healthcare company which contribute in elimination of communicable disease. On the flip side, a software or tech companies, they doesn't have business activity that contributes to environmental or social impact directly. How does your strategy relate to these companies?
Hi. First of all, thanks, Kevin, for the kind introduction at first. And I think there are kind of two questions in the question that you are asking. So I will just answer in two sections. So on the first part, how we kind of incorporate ESG. So for the funds that Leslie mentioned just now, the Global Sustainable Equity and Global Sharia Sustainable Equity Funds, these two funds are aligned to SDG goals, which are known as Sustainable Development Goals. And my colleague Nabil has shared the slides that you are seeing on the screen right now. These two funds focus on 6 impact goals out of the 17 SDGs. And why we picked 6 of them is we feel that we have the expertise and that's the areas that we can contribute the most to provide the positive impacts for the investors in the funds. And the 6 impact goals consist of mitigate climate change, mitigate natural capital depletion, global access to basic financial services, global access to clean drinking water, eliminate communicable disease, and last but not least, mitigate the obesity epidemic. So with these 6 impact goals that we have in mind, we keep this into consideration when it comes to the stock selection and how we go through the positive impacts that the stock holdings could contribute to these positive impacts. On the second question that you have, some companies or some sectors that we invested in are not on the first glance contributing positively to the ESG. That's not necessarily true because ESG by no means have the simple meaning of it, and there's on the other hand, it consists of these impact goals that we have, and I think a lot of the audience and the investors are not quite aware of all the goals that can contribute to ESG or contribute positively to the stakeholders. And for example, the healthcare companies that you mentioned, that actually aligned to one of the goals that we put ourselves on the front for the funds that we manage, which is to mitigate the communicable disease or to provide global access to clean drinking water. I think the last point, which is the IT, that's more controversial, and when people think about IT, it's hard to relate to ESG because their understanding might still be CO2 reduction and how the IT sector is relevant to ESG. But if you relate to one of the 6 impact goals that we outline here, which is the global access to basic financial services, there are actually a few holdings that is within the funds that provide the global access to basic financial services, such as MasterCard and Visa and the likes of the names that the public consumers have always used for their basic consumption. And with that, it just brings you to indirectly or actually subconsciously provide to the ESG that we are targeting for the funds.
Well, yeah, from Tien, we know that ESG is not only for the direct impact, it also contribute indirect impact in terms of for the companies. So, Tien, I got another question for you. Can you describe what role of ESG considerations play in an investment strategy, and what kind of ESG-related investment conviction this is based on, and how this is reflected in the investment research and decision-making process?
Yeah. Thanks for the question again, Kevin. In simplified words, we consider ESG throughout the stock selection process. And when we look at the companies, we also consider the ESG issues that are outstanding from either their sustainability reports or the proxy reports, or even from third-party resources like MSCI, where we could identify what are the issues that are outstanding for the companies that we are interested in fundamentally. And we either will be engaging with the companies for those issues in terms of how we could help and how we could direct to mitigate those issues and try to provide positive impacts. And throughout the process, we discuss the stock fundamentals in a team approach, where we also have the scorecards being created for the companies that will be included in the funds. And throughout the stock selection process, there will be team discussions going on, where each team members will have to argue, the pros and cons of that business practices. And in the end, we will come to a conclusion whether to include or exclude the company into the funds.
Thanks for that, Tien. Currently, we are seeing more and more companies have raised their awareness of how ESG is crucial in their daily operations. However, Tien, does driving an ESG agenda means that you need to sacrifice the company returns?
I think that's a very typical bias towards, you have to sacrifice your financial performance for the ESG part. For the funds that we actually have the objective of delivering double bottom line, which is to deliver the positive impacts and the performance at the same time. If you think about it, ESG is never a bad thing because it doesn't really hurt your performance if you hold your fundamentals strong and you follow the valuation discipline that we have here, which we don't just blindly follow all the ESG teams that are out there, where even though it might align to one of our 6 impact goals. For example, if you look at the past 2 years, there have been always hypes throughout the hydrogen industry, as well as some of the electrical vehicle space, such as Plug Power or the Nikola. I believe these are a few names that have great performance, but it's really hype. And now that you look at the recent performance, you could see that if you follow your fundamental due diligence strictly, where you wouldn't believe that they should deserve such high valuation multiples, they actually return most of that, at this point, if you could look at some of their share price performance. So in essence, we don't believe that you really have to, sacrifice your performance, as long as you have a strict discipline towards the valuation part, and believe that the performance, the business practices or the models that the companies you are invested in are on the right direction and at a reasonable valuation.
Right. Thanks, Tien. I still have a last question for you. Well,
Okay.
When we come to investment, it's not only about the return. We also need to take consideration to our risk. So, Tien, would you mind to explain how do ESG metrics impact the strategy's risk management?
Yeah, that's a very good question. I think when people talk about ESG, they hardly relate that to risk management. But when we look at ESG part, it actually is a tool for risk management if you think closely into it. For example, if the company that you are invested in are on the right track of doing, ESG business, for example, renewable energies, and you wouldn't get involved into some of the oil businesses or some of the practices that are against what regulators are striving for. If you are avoided those businesses, you could actually avoid potential fines from the regulators. That's actually one of the risk management that you could obtain from having ESG considerations or incorporation in your investment process. On the other hand, it also acts as a tailwind when you think about it, because when regulators are on your back supporting all the renewables or all the business practices towards the sustainable goals, you are actually having the bills or the subsidies that will be provided by the regulators. It's not a 100%, you will get the support through the financial stimulus or some other tools that could help into the ESG track, but it's a good thing to have because it will be additional option for the companies that the funds are invested in. There will be kind of an optional tools, and also will be a sentiment driver for the companies as well. I think you are muted, Kevin.
Oh, sorry, I was muted just now. Well, Leslie, do you have any historical data to prove that ESG investments are more resilient and able to withstand the sell-down pressure during market downturns? This year we have been seeing a lot of macro backdrop due to a lot of uncertainty. So, does ESG investments meaning that you have more intact fundamentals?
I think there will always be data out there to support such calls that ESG is stronger, ESG will be more resilient. I don't, from a fundamental point of view, I don't disagree, but because ESG investing, it's new in the sense that before this there's no clear definition of what is ESG investment. It's new. It's because it is something that has more or less taken place in the last, call it decade, and more so in the last 5 years. So when you have that short period of time, I think it's very dangerous to say that, oh, we have data to back up that ESG is actually going to be better or be able to withstand. I think the key point that investors need to understand is in an environment of, let's say, sell down or pullback in the markets, stocks in general will be affected. Stock prices will fall. Obviously, when we talk about investing from an ESG perspective, you need to think about longer term. It is an investment, right? We are not saying that just because you have a better ESG, better governance, that, oh, in one quarter itself, your earnings is going to turn so good that the share price can go against the market. We are not saying that. At the end of the day, investors need to be very, very clear that ESG is a long-term and you see the benefits of it over time. So to answer your question, I believe that common sense also will play a part in the sense that if you think about ESG, give you some very, very simple examples. If a company is very conscious of its carbon emission, it doesn't pollute the environment, they won't get fined. When they don't get fined, or they don't get into trouble with authorities, there won't be an impact on their earnings, right? They won't. Fine means maybe less profitable. So good E means normally better earnings. In terms of S social, if the company is doing all the right things, impacting the society positively, that's that sort of brand building and awareness by consumer. So what does that mean? People will tend to maybe consume more of the service or the product. Or put it another way, if they treat their staff very well, still on the S society, right? Normally you will have a stronger company, a workforce that's happier, and normally that means that efficiency is higher. Now, all these things won't happen over time, and all these things won't mean that the share price won't pull back in a downturn, but all it means is that it's a better company, well run, and when we recover from any slowdown, we should be able to see it outperforming the rest of the market.
Well, thank you, Leslie. Next question I'm gonna ask you is a little bit burn. So okay, so next question. Is ESG still relevant given what has been happening around the globe? So is it a hype or a circular trend? And what's the significance in ensuring our investments create a positive impact? And if any, this is a conscious decision in all things we do. And with so many avenues for everyone to create impact, why you still choose impact investing?
Wow, there's quite a few questions that I'll try to remember. And if I miss out any points, just remind me. So, okay, is it a hype or is it a secular trend? I think it's a bit of both, and let me explain. Secular trend, it's because it is happening, and you have a lot of top-down meaning governmental level, countries all pushing this whole ESG consideration at business level, at investment level. So, like I said earlier, pension funds, sovereign wealth fund, they're all incorporating this. So I don't think that will change or reverse overnight. So in that sense, it's secular. Previously, when we make investment, we spend a lot of time on the G, governance, right? To make sure that the board are responsible in their decision making, that the minority shareholders are protected. So a lot on G. So now we're just adding E and S into the picture when we analyze companies. So I don't think that's going to go away. I think that part is secular. Now, why I say it's a bit of both hype and secular. Hype in the sense that, as usual, markets get very overexcited when there's a new theme coming up. Obviously, ESG itself is a theme. And people get too excited, it creates a hype. So whenever someone say, oh, green technology, you see everyone rushing in and looking at this space or pushing it up. Or when people start coming to talk about, oh, ESG, everyone starts to implement ESG, coming out with, big policies. And, when you do that, sometimes you don't realize that you may be making some mistakes and you need to take a step back. But it's okay, right? Making mistakes is part of the process. Now, what I mean, again, by making mistake and maybe a bit of hype, you can also see nowadays, given the Ukraine crisis, right? Energy prices going up. There are countries in Europe which are big advocates of ESG who are now dialing back and say, whoa, hold a minute. If you're not getting enough gas, we might have to start to use coal power plants and maybe nuclear plants to keep ourselves warm in winter. Now, does that mean that they are, pulling back on ESG? No, but I think what they are trying to do is be a bit more realistic. Maybe their actions in the last few years have been too aggressive. Maybe certain things that they didn't expect to happen. They could, they weren't prepared for it. So, yeah, that part I would consider a bit of a hype, but definitely it's going to be secular. When it comes to investing, I don't think it will change. People will and should consider ESG in their investment. So I got one part of your question covered. Sorry, the other one was, why should we consider?
Yeah, the second part of the question is, since you got so many ways to create impact to globe, so why are you still choosing impact investing?
Again, back to my answer to you at the start is, for us, it's just a simple right thing to do, right? So nowadays, when we go to work or when we drive our cars, we think about, oh, maybe we shouldn't drive, maybe we should walk, whether it's for health reasons or, oh, let's not pollute the environment. Or when we go to pack our lunch for work or to school, we pack nicely, we wash our Tupperwares instead of putting it into a plastic container and chuck it, right? Or maybe we now use recycled coffee cups. Now, if you do that in your daily life, why should investing in creating wealth be any different, right? You can't be saying that, oh, I believe in doing the right thing for society and for the world, but only when it comes to eating out or when it comes to food. When it comes to investing, I don't need to have positive impact. Oh, I believe when I drive my car, I have the positive impact, but not when it comes to investing. I mean, it doesn't make sense, right? If you can do for one, why can't you do for the other? So it's just that we all should live our lives from the way we consume our food, the way we drive, the way we travel, the things we buy, all the way to the way we invest, right? And at the end of the day, there's certain, if I use the word power behind wealth and money. And if you can use that sort of power, inverted commas, to do good and create positive impact, why not? Right? So that's a very simple and I think logical way to look at the issue.
Well, thanks, Leslie, for the clear explanation. Well, Tien, would you mind explaining to us, does an ESG lens limit your investment opportunity set?
Right. I think a simple question is not really, because when you consider ESG lens, it's just additional layer when it comes to your stock selection process. And ESG lens, to be honest, is just restrictive in general, because when it comes to the availability of data that you could collect, and some of the companies that you follow didn't actually have enough data and enough track record for you to prove that they are doing the right thing on the ESG level. It's that kind of general aspects that put the restrictions into investment. For example, if you compare developed versus developing countries, or just in general developed companies in developed countries versus companies in developing countries, those are significant because when you come to developed countries, they have established very mature businesses and they have achieved a certain level or certain sizes where they have enough resources to do more of this ESG work. On the other hand, when you look at companies in developing countries, they are still growing very fast and their focus is more so to either capture the market share or to grow their business size. So it doesn't mean that they are not doing something on the ESG level, but on the paper work, there's nothing that you could have it on your hand to say that these companies in the developing world, they are having positive impacts through one of the ESG lens. Hence, we think that it's just more so of that part that restrict you when it comes to investment. But when it comes to the obvious reason which would limit us is that the ESG lens will kind of screen out the energy sector. So if you are those who really positive on the oil and gas names or very positive on the energy sectors, perhaps this could be a restriction for you and not very keen on the funds, because the two funds that we have now have zero exposure through the energy sector, because that doesn't align to any one of the 6 impact goals that are outlined at the start of the Fireside chat.
Well, Tien, I have another question for you. So everyone knows ESG is positive to our environmental in terms of social and governance. So yeah, with the rising awareness of ESG, we have also heard of another opposite side that claim that ESG is a scam. So can you explain what is the terms known as greenwashing and why I should aware of this?
Right. Greenwashing, before I get into the answer, perhaps Nabil, can you share the slide? So greenwashing, I don't really have the definition, the official definition for it. Give you an example of what greenwashing has been issue when it comes to ESG. If we look at the left-hand side chart, greenwashing has always been on top of the concerns of the investor's mind when they're looking to invest in the funds that are doing positive impacts to the environmental, to the society. But there's no concrete evidence that is provided by those funds because of any reasons that they have, or it's just because of greenwashing. They are trying to use the ESG words to collect more attentions and to gather more funds for their strategies. Throughout the pandemic and until 2022, the ESG funds have really caught up to the hype, or to the spotlight on the stage to gather the funds. And until now, I think more and more of the funds are getting their backlash from the regulators such as SEC, targeting all the funds without concrete evidence that they are showing ESG work in their investment process. And that's kind of an easy understanding for the greenwashing. And if you move to the next slide, Nabil, for us, when it comes to greenwashing, it doesn't really benefit the investors, because if the investors are really ESG minded and they would like to utilize or leverage on the big capital entities like us to provide positive impacts to the society, they are actually not getting anything back if the fund is actually greenwashing. But for us, not only that we really put efforts into engaging with companies on specific issues, we are also very transparent when it comes to providing feedback to investors what their money actually has generated and have provided certain impacts back to the societies. And on this slide, you could see that we categorize in 6 columns, aligning to the 6 impact goals that we have outlined just now. By having 1 million invested into the funds, you have all these numbers that you could see here. For example, eliminate communicable disease. Per $1 million being invested into the funds, 23 low-income patients will be reached with treatments. This is an example of what we are trying to provide the positive impacts, and we are trying to ensure the investors that their money is not being greenwashed, and we are actually using that money to provide concrete impacts positively.
Thanks, Tien. Well, Leslie, it has been a tough year since earlier 2022, and I believe that a lot of investors are concerned how to position themselves in this market. So, Leslie, would you mind sharing some insights on the market outlook for our investors here?
Yeah, I'm sure, yes. Given what we have experienced in the last, call it, 9 months or year to date, that's also everyone's question and concern. But I think taking a step back, I just want people to also realize that at the end of the day, the market is the market. We can't have a, one-way straight line up, even though that's all what we want, right? Stock prices just go all up, go up, up and up. If you think about the last 2 years, we had a period whereby, something that, in our lifetime or in history, probably, we never experienced, whereby you can say that, the whole world was under lockdown, right? Because of COVID. And because of that, a lot of the central banks did things that no one could have imagined. Your economic textbook wouldn't have taught you, even if you study in the best universities in the world, of what potentially central banks can or would do, because no one saw that coming. But the point is, these governments, push out so much stimulus, increase the balance sheet size by more than triple or quadruple in a very, very short period of time, right? To be able to support an economy that has just collapsed because there's no economic activity, right? So during that period, asset prices, whether be it bonds, be it equities, were just pushed up or supported by this sort of liquidity, right? To make sure that we don't go through a very, very negative sort of, downward spiral in the economy while we battle the pandemic. Now we're all very happy in terms of our lives because we are back to normal. Similarly, in financial assets, things need to go back to normal, right? So central banks are already, turning off the tap. They need to bring in the liquidity, okay? And because of the inflation that's going on, they also need to make sure that we don't grow too fast. We all complain about inflation, but we also see and experience that, right? Many people have either, gone through a period during COVID that, they need to reevaluate or review their lives. Some people change jobs. Some people say, I don't need to work. And as a simple result, and, maybe we know people who have done that, created sort of a temporary shortage of workers. And when you have 2 years or 3 years of, hiring or plans that couldn't be, act upon, suddenly everyone's coming back, everyone to do the same, same hiring or same thing, all at the same time. It's all economics 101, right? Demand, supply. So inflation is going up. So all these are just right in front of us. So I think in terms of the market, we are just going through a period of reset, or you might call it normalization. Okay, a period whereby, again, because we never have that sort of experience of COVID, never the experience of how the central banks reacted, we are also trying to figure out where we are today, how we're going to deal with this. So this sort of volatility, this sort of adjustment is taking place right now. And as you can see, the markets, whether it's in fixed income, whether it's equity, it's a bit of a quandary. Okay, why I say that is, given what I've just shared, more or less everyone knows that. It's just a reminder. Now you have the economy struggling to grow because there's shortage of products, there's shortage of workers, inflation. On the other side, you have the central bank trying to manage post-COVID by either sucking out liquidity, trying to ensure that inflation doesn't go too much, to the point that the US Federal Reserve or any banks in the world are trying to say that, well, maybe we need to see some sort of a slowdown just for us to have that a bit more time to reset or adjust for all these shortages. And because of that, investors, including ourselves, are struggling to say, what does that mean, right? At one point, you can see that people want to go out there and spend. People want to, factories are trying to produce to meet demand. But on the other side, you have the government trying to push back and say, well, hold a minute, don't grow so fast, don't grow so fast. In fact, we want to slow you down. And then here we are raising rates, the US raising rates, and the rest of the world have to follow. So because of this uncertainty, I think a lot of investors are just being very, very cautious. Some of the clients that we speak to, or some of the surveys that we follow, indicate that people are holding a lot of cash, right? 30-40% cash. Again, if you're holding too much cash, maybe you can earn 2-3% interest by putting it in the bank. That's great. But is that good enough? Maybe not. There will be a point in time whereby people say, whether it's our, buying bonds at 4%, or maybe equities, earnings are not so bad. You can sort of generate sort of free cash flow yield of 5, 6, 7, some global companies even up to 9. They may start to become attractive again. So we are in a period of trying to discover where we are. Earnings is very important. So I think for those who invest globally, this month, October, will be a third quarter earnings season. So that's something that to look out for. And then people will get a sense of where we are. So I'm not sure I can give you a clear answer, but I'm just sharing with you what the team is looking and seeing out there, the various pieces, moving pieces, uncertainty. So yeah, at the end of the day, for us, we go back to the companies. If it's a strong company, the right products, the right services, good margins, and the ability to still be profitable in a, let's call it a down cycle, then we are happy to continue to invest and hold on to it.
Thanks, Leslie, for the market update. Well, Leslie, I have another question for you. So, what is the investment strategy that you recommend to investors to invest applying ESG concepts while riding on the current market turbulence at this juncture?
Yeah, I think just being more defensive makes sense. Now, when I say defensive, doesn't mean that I just go all the typical standard companies that are seen as no growth, because that's defensive, right? Growth, everyone's so worried about growth. Whereas 2 years ago, you talk about growth, everyone is jumping into growth. But I think just back to my point, companies with either strong brands, strong products, obviously, if you are highly levered balance sheet, beware. Okay, if the company has a lot of borrowings, beware, because again, I don't have to tell you basic investment 101, right? Because the more borrowings you have in a rising interest rate environment, you're going to pay a lot more, and your profitability will be squeezed. So stay with good fundamental companies. Like I said, for every cycle, and we've seen quite a few cycles, there will be companies that come out and be stronger and bigger than the last cycle. So stick with this strong balance sheet, strong business model companies. And obviously, being a fund manager, you'll always be biased. Look for the right fund manager who can find these stocks for you. And hopefully Nomura is one.
Okay, thanks, Leslie. Well, Tien, just like you mentioned, Nomura have come with two ideas, in this ESG fund, which is Nomura Global Sustainable Equity Fund and Nomura Global Sharia Sustainable Equity Fund. So, what's the difference between these two funds? Tien, I think you are muted.
Sorry, yeah. So the difference is mainly the benchmark. So given we have the Sharia for we have one conventional version and the other is being Sharia version. Obviously the Sharia version will have the Sharia benchmark, Sharia compliant benchmark, and hence you would have two different benchmark. For the conventional one, you would have the ACWI by MSCI. And for the Sharia version, the benchmark will be using Dow Jones Islamic Developed Market Index. That gives you the main difference. But we do think that, in these two different benchmarks, there are certainly overlaps. And also when there's no overlaps, they will be having their own best ideas within their benchmark. But I would say, regardless of the differences, we manage both funds in the similar process and the similar philosophy. So other than the benchmark differences, for example, in the Sharia version, we know that Sharia compliance, it means you could hold no financial related companies. That gives you kind of the no exposure to the finance sector. And if you would like to have the finance sector and if you are non-Sharia investors, then perhaps you would prefer the conventional version. So that's the differences. But back to the similarities, like I say, the funds will be managed by the same team with the same philosophy and the same process. So other than the financial part that I mentioned just now, I think most of the similarities for the funds would be quite high.
Thanks, Tien. Actually, just now I just look at a fund spec sheet, and I noticed that Nomura Global Sustainable Equity Funds, it always IT sector at about 26% as of its August fact sheet. So may I know why this fund employed this strategy instead of what we usually see in another ESG funds to overweight on the industrial or healthcare sector?
Understand. I think that gets back to the second question that I answered previously. It was a typical bias that people would have in mind, when it comes to ESG funds, you shouldn't have exposure to the IT, or should have lower exposure to the IT because it doesn't relate to ESG on the first glance. But back to the 6 impact goals that I mentioned just now, if you think through one of the 6 impact goals, which is to provide the financial basic accessibility to the financial services. Within the ITs, you could actually have some of the names that align to those goals. That's one of the reasons we have overweight to IT. But the other reason is also that IT doesn't really just mean not ESG friendly, because when you think about the size of the IT companies, they do have a lot of capital to plow back to doing ESG works, and it makes sense to have IT exposure where they have done significant efforts into trying to provide the positive impacts back to the society or to the environment. That's kind of what I would wrap for having the overweight in, not the overweight, but to have that 26% of our allocation to IT. But I want to mention is also that we should not just look at that IT exposure, because if you look at the second or the third sector allocation, is actually the healthcare and industrials. I would believe that investors could relate more towards the fund is doing ESG and really contributing some positive impacts. I think we shouldn't just look at the first the highest exposure for the IT allocation in the fund.
Thanks, Tien. I got another question for you. So with the heightened recession fear globally, will this affect the country's allocation of Nomura Global Sustainable Equity Fund, which currently is overweight on the US with approximately 50% moving forward?
I think we are aware of the macro move and also all the headlines like what Leslie mentioned just now. It's part of the investments, but it's not everything, because first of all, we are bottom-up funds and we are not top-down funds where macro is everything and it drives every investment process or decision that the managers would have done for the funds. So we are aware of that macro impact, and how we should kind of accommodate our allocation to that macro events. But we are investing in global equities. So when you think about global equities, take a step back, it means we are having companies in the funds that have businesses not just in US, not just in EU, but it's actually across the globe. That gives you kind of the diversification as well. And with that, we not really, I want to say that we don't just focus solely on macro and say that we could be doing fine with just the fundamentals. We do consider the macro and how it will impact for example, the top line revenue for the companies or the cost inputs for the companies. But we don't just rely upon that and make our decisions. In fact, we look towards the long term, and we have our focus more than just the next 3 months or the next 6 months, how the macro will turn up and how we should kind of be prepared for that. We like to focus more on the long term and make sure that we have the right companies in the fund or the strategy to also not just deliver the performance, but also to deliver the positive impacts that we would expect the holdings to have in the future.
Hi, thanks, Tien. Now, yeah, we do have a question from audience. So, most ESG companies are young and have not seen a bear market or recession. So, what are the average age of companies in your ESG portfolios? And what is the percentage of the stocks in your ESG portfolio that have gone through a bear market and recession in the past?
I can take that question. So we don't measure like the age of our companies, but I would say what we have in mind is for those new companies that have just public listed, most of them are not generating any cash flow at the first hand, and those companies are not in the fund, and especially at this moment and at this juncture where the macro environment is getting tougher, the holdings that we have would have sufficient cash and would have strong fundamentals where we believe that they could ride through this tough environment and come out stronger when those companies, young companies, where they do not have stable cash flow generation would be eliminated. Hence, we will see the holdings that we have come out stronger and capturing higher market share out of this macro headwind. So I don't know whether I answered that question, but we don't really look at the age and how they have gone through the previous bear market, but we do incorporate the quality of the management when it comes to the stock selection as well.
Maybe I can jump in here. So these are not, by the way, whatever I'm sharing, these are not official, and we haven't really checked in detail. I had a quick look at the portfolio. I would say less than 10% of the companies or the weight of the portfolio are companies that were, haven't gone through. I wouldn't say haven't gone through, but maybe weren't listed in the, let's say, called the last global financial crisis. But they could be operating then, and I would say most of them are global companies with very, very long business track record. Right. So a very small amount. There are companies that maybe were only listed post the last global financial crisis.
Hi, thanks, Leslie and Tien for the explanation. Well, thanks for the insightful sharing. Leslie, would you mind to give quick summary as a wrap up for today's session?
So yeah, thanks for everyone's time and for us to be able to share with you our thoughts and our views on this topic. I just think that a lot of people are now being given so much information, different fund house talking about ESG. You read in The Edge, you read in The Star, everyone's talking about ESG. So you might be very confused, or we might have made it more difficult for you to understand. But the key takeaway is investment is investment, but the additional part that you have to really understand is you need to know what is the fund doing for you when it comes to ESG. I think you raised the question, Kevin, about greenwashing. That's very relevant. So you can't be lazy when it comes to investing. There's no such thing as simple, or easy way of investing and generating good returns as well. So what I'm trying to get here is that you need to go in, understand and read about the fund or the product that you're investing, especially ESG. We try to be as transparent as possible by giving you the information, not just through Fund Fact Sheet, our websites, all our products, our quarterly report on our engagements. It's all made available so that investors can really understand what we are trying to achieve with this fund. So people always ask me, how do I know whether it's Nomura Fund or ABC Asset Management Fund, XYZ? fund. How do I know? I said, very simple. You ask the fund manager, you ask the company or the fund, owner, what sort of information can you provide me, right? If you just give me your standard fund fact sheet and say that, oh, we invest in impactful company, and you show the 1 year, 3 year track record, 6 month performance, top 10 holdings, that to me is just any other fund, right? So whereas someone who can give you a bit more detail on what they do, someone who can measure the impact, to me, that's differentiated. So anyway, but the journey about investing, or the journey of ESG investing, it's still at a very early stage. I'm sure there'll be certain changes or maybe even more development, but I think it's good that investors will at least keep abreast with the developments, know what is it all about. And at Nomura, we try to continue to share, educate, and also have the right products for investors who are interested in this area. So yeah, thanks for your time.
Thanks Leslie and Tien for your time attending our events today to provide us some insight on ESG investment. So in line with this fireside chat, a kindly reminder that FSMOne has a bonus unit campaign on two funds that Tien had mentioned just now, Nomura Global Sustainable Equity Fund and Nomura Global Sharia Sustainable Equity Fund. So the first 50 clients to invest a minimum of 1,000 in one of these two units above will enjoy 100 ringgit bonus units start from 4th of October until 28th of October. So that marks the end for our event today. Thank you, Tien. Thank you, Leslie. Thank you so much. Thanks for your time and have a nice day.
Yeah, same to you. Good evening, everyone. And good night.